market, you're probably investing in stocks, but options are another great investing resource that allow you to hedge, to protect yourself from missing out on gains, to protect yourself from losses if utilized correctly. Some people actually use options to earn incredible returns that would crush the typical stock market return. Now, no surprise, there are risks when it comes to something like options. It is more of a high risk, high reward, but it depends on how you go into it. The riskiest form of option trading, which I don't recommend, but I'm going to share it with you just because when a lot of people think of options, they think risky and avoid. The one strategy you definitely want to avoid is uncovered calls. Uncovered calls is the only way with options where you have the ability to lose more than what you put in. Uncovered calls is pretty much you're shorting the call and you don't have the 100 shares, and literally don't stay away from them. But when it comes to buying calls and puts that make sense based on your portfolio and your goals, or when it comes to selling options that are covered, which means you have the 100 shares in the case of a covered call, or you have enough cash in the case of a cash secured put, all this we will talk about in this training. You have the ability to increase your income, earn more from this strategy than you would just like buying and holding dividend stocks and waiting for the dividend, which is a good strategy, but options really can amplify. And there are a lot of dividend investors who also leverage option selling as a way to increase their income. So in this class, you will be learning just some of the ways you can buy options and the revenue potential, and also some of the ways you can sell options to make some extra income, making decisions that you would have no problem making anyway. So we're going to be talking about all of this in the training, and I look forward to seeing you there. They actually do some of the different strategies you can use to boost your returns. So we're going to go right into it. In the case of buying a call, pretty much what it means is you are bullish. You expect the stock and the more that stock or ETF rises in value, the more valuable your call becomes. Not only can you exercise it at the same strike price you originally set, but if you decide to trade call, so rather than exercise and get the shares, you just want to trade the call. So you buy the call, the stock goes up in value, which means the call goes up in value, and then you sell the call for a profit. Either way, when the stock price goes up, it helps with the call, and you are essentially making a bullish bet when you buy a call. So there are a few different ways that you can leverage. You can use calls to boost your returns. The first strategy is right before earnings for a company that you believe will go up and that you would have no problem having the shares. Buy a call for that stock. Now, some people, they will put their entire life savings into a single trade, and I strongly do not do that. It's a very popular concept right now with Wall Street bets, but it isn't something you should do because it's one of these things where if the stock does really well during earnings, it will surge in your return. Like sometimes if you are buying calls, and the same thing with puts, you can see the value of that call double in one day, triple in one day, quadruple in one day, stuff you would never expect to see with a stock. But at the same time, it could go down 50%, 75%, and even down to nothing in one day if the stock falls so far out of the money due to a bad earnings report. So the reason I recommend buying a call right before earnings for a stock that you like is because there is this FOMO factor where people feel like they want to rush into the stock and right before earnings, and then if it goes down, you're stuck with that. So you see this a lot with stocks that rise up, and it seems like there's no end. And stocks do not go up forever, no matter how promising the company is. And you have that even if they have really good earnings, they will still crater because they were below expectations or because there was a massive run up to earnings. So the reason I recommend, again, buying calls is because instead of buying the 100 shares and putting in a ton of additional money, risking a ton of extra money, which in this case, you have the underlying shares, so you could wait for it to go up, but you risk a lot less money with buying a call versus buying the 100 shares. And then if the stock goes down 10%, like your call will get decimated, especially if the expiration date is very close. But you're losing on just like a small amount of money you put into a call rather than the money if you actually bought the 100 shares. So if you want to get into a stock, you got a little bit of FOMO. Instead of putting all of your money into the stock before earnings, just buy a call. And if the stock skyrockets, you have the ability to get in at an attractive price. This is a way to protect yourself in case the earnings go south. Another strategy for buying calls is to buy a really far out call for a stock that you like. So you want to, again, be very careful with the strategy because you could double, triple, quadruple, some people even 10x, 20x, but at the same time, if the stock doesn't move your way, it's not going to work out very well. But if you do give yourself a bigger window, you do pay more premium because if an option expires in 1 year, it's more risk on the person selling the option, and that's going to be a higher premium. But at the same time, the stock has a year to hit that strike price and to blast well past that strike price. So it makes sense to go for those further out expirations. Some people, they look at premiums and they're like, oh, I'll buy a stock option that expires tomorrow because the premium is super low. But that is gambling, because a stock, like if you buy a far out call, then there's this idea, well, oh, there's a long-term play happening. But in the case of buying calls that expire the next day because the premiums are so low, you don't pay much to get into them, that's a gamble because even the best company can go down in a given day for no good reason. And I don't want to like have that type of risk, even though the premium is so small. So pretty much buy the calls if you are bullish, and earnings is a time where the calls can dramatically jump in value. And it's a good way to protect yourself instead of buying a ton of shares. It's also good to do these far out calls that are also decently out of the money, because then that means like the further out of the money you go, the lower premium you have to pay. It is a good way to balance out the fact that premiums are going to be higher as you go further out. And if you are one of these people who shorts stocks, definitely buy a call on that position, because buying a call is the main way, other than closing out your short position, to actually limit losses. So now that you have an idea of how buying calls works and just some of the different ways you can approach this strategy, we're now going to talk about buying puts in the next video. To buying a call, you are bullish, you want the price to keep going up. In the case of a put, you are bearish. You want the stock to keep going down in value. So some of the reasons why you would want to buy puts is, well, similarly in the call scenario, you buy it right before earnings because you think the stock is going to tank. And instead of doing an extremely risky shorting the shares, you buy a put instead. Because when you buy a put, the worst case scenario is that you lose all the money you put into the put. But if you short a stock, there is unlimited losses unless you do corresponding call, which in that case you would cap your losses. So that's one scenario where it makes buy a put. Another scenario is to buy what's called a protective put. So let's say you own 100 shares of company, but you are a little nervous the short to midterm. If you're nervous about a company over the long term, you should be looking to get out of there. But maybe you're nervous about a company in the short to midterm, in which case you can buy a put that gives you the ability to sell shares of that company at a certain price. So let's say that XYZ stock is dollars per share and you're nervous that it could go down. So you decide to buy a put that lets you sell all the 100 shares at $100 each per share. Now, let's say the stock goes down to $90 per share. You are still able to sell at $100 per share, even though the market is saying that they're worth $90 per share. That's why you pay that extra premium. And it's also that the stock goes up to 110, the value of the put gets decimated. At least you had that protection in case it went down. Again, we just want to share both sides of what can happen with options, because there is a risk-reward ratio to pay attention to here. So you have the ability to sell the shares in this example at $100 per share, regardless of how low they go. But some people, they will buy the puts and then not sell the shares. Instead, they will buy the put, see the stock get hit in the short term, maybe a correction, maybe something even worse. And then they decide instead to sell the put because the put will go up in value, corresponding to how much the stock price decreased. So you can get the capital gain on the put rather than getting the capital gain on the stock. This is a really important detail because in puts, if you do exercise and you do end up, well, in a call, like if you buy a call, you would just get the shares. But in the case of a put, you would sell the shares. That is still tax that will affect your capital gains. So that's why some people, they'd rather sell the put versus exercising a put. So before one of those gets exercised, just look to see what your capital gain is. If you're in the red, like for that whole position in total, then it's not going to hurt you. It may help you if you have a big capital gain, but you do want to keep taxes in mind when it comes to puts getting exercised. You could also buy a far out of the money put with far expiration if you believe the stock is truly going to tank. That would be me with a stock like Nikola Motors, which recently it just has a whole bunch of fraud stemming, and it's not a company that you want to be holding. So that would be the type of stock where if you really think it's just going to tank over the long term, buying a put that has a far away expiration date could be a strategy that you utilize to get higher returns. Of course, the further away the expiration date, the higher the premium. You can compensate by picking a strike price that is further out of the money. It doesn't make sense to do that strategy with every single stock because, again, it would have to get decimated for you to get the returns that you were looking for, but it can be a very sizable return if you guess correctly. And it is a stock that, just based on the fundamentals, looks like it's in for a very bumpy ride. Shorting the stock in this case, it just ensures that if the stock does go down, then you are riding out all of those gains instead of the put where the timing has to be there. But with the put, you don't have this idea of unlimited losses and you don't have the interest rates that apply for people who are shorting stocks. And margin is just a very risky investing strategy overall. It's definitely not for everyone. That's why buying puts makes sense for more people. So now we've talked about and puts. We will be providing some examples as well, but we just want to introduce the concepts. Now we will be talking about the different ways to sell options. We're going to be talking about mainly the covered call and the cash secured put. We are not touching the uncovered calls. That is a very dangerous strategy that can go very badly if the timing isn't there. So covered calls and cash secured puts are what we're going to talk about next.